Welcome back to another edition of Making Sense. Yeah, we're still here. We didn't change our clothes. Still the same as the last one. Digital Dove, Zack Moneybags, Greenberg, Rafi, the real estate guy. All right, Rafi. So last show we talked about general broad overview of real estate investing. If you could bring us into like a couple of different kinds of deals, how people would actually make money in real estate, other than House Flippers or whatever show on HGTV that they're watching that really doesn't actually work, and all those people lose their money. All right, go ahead.
So again, yeah, house flippers, one sector of real estate. Not for me. That's a job, hands-on job. What I want to focus on is a regular guy working. He works as a doctor, works as a lawyer, but he wants to get the benefits of investing in real estate, right? How can I do it? I work 100-hour weeks. I work as a doctor, night shifts. I don't have the time for real estate. So I say, great, let's partner on deals, right? But how do you know it's a good deal, right? How do you compare different opportunities from different real estate investors bringing you opportunities? So if you guys want, I can share my screen, show you two different types of deals. Give me 1 second.
You should be able to do this. There we go. All right.
All right. You guys see me?
Yep.
All right. Let it come up.
Okay. Little Google Doc. Okay.
Oh, wow. It's a nice place.
You like that, right? Okay. 1 second.
Is that Avalon?
What? No, I just looked up,
Okay, it looks like an Avalon.
It could be. So let's just try to break this down. It's a lot of numbers that could overwhelm people. Very simple one, just broken down. If you guys have any questions, stop me. Okay. So let's assume I'm putting together a deal, right? And I say to both of you, I say, guys, I need $200,000 to close on a deal. And you each say, great, we have $100,000 in the bank. We'll put into the deal. So how do you know what type of returns you're going to get? How do you know what type of deal it is, right? I say this deal, home run, clean, very nice building. You have this nice multifamily. It's 200 units. It's in Florida. It's in Miami, right? Great. So I say to you, it'll be steady cash flow throughout. The plan is in 5 years, we're going to sell the building. That's when you'll receive back your entire principal that you invested. But throughout the 5 years that we hold it, you're going to receive cash flow. You're going to receive X amount of returns of the total cash flow. You're going to get 70% of the cash flow. And I'm going to take 30%, whatever structure we come up with. So
I thought you said that if you put in $100K, then you can only get like $400,000 in like mortgage with the mortgage.
Sorry. So let's say for example, let's say this bill.
I'm not just being nitpicky. Forget like maybe.
No. Let me explain. You're right. This building, let's assume, is $800,000 only, which it's not going to be. It's probably going to be 20, 30 million, depending on the market, right? Okay. Let's say this building's only $800,000, and I need 25% of that as a down payment. So
okay. So in your typical building investment, you need 25% cash to buy it. So if it is in fact $80 million, you would need $20 million in cash to buy it.
Correct.
Okay.
Correct.
Good. All right. Correct. Fine. We'll work with that.
For this thing, just so the numbers don't get too wacky, let's assume it's $800,000. We only need $200,000 to close. So I go to Digital Dove, I go to Zack, and I say, guys, give me $100,000 each, and you guys will be my limited partners on the deal. You'll receive majority of the cash flows, and it'll be a great deal. Okay. Fine, so you each give me $100,000 right over here. Mm-hmm. Each are down. The reason I make it a negative here is because you gave me the $100,000. So you're in the red right now.
So the parentheses are
correct.
Yeah.
Year one, you receive cash flow. This is after everything, straight money that goes into your bank account. $7,100. Solid. 7.1% return on your money. Not the stock market might blow that out of the water. However, remember, this is cash flow. This is not equity built up in your stock portfolio. This is actual cash flow that's going to coming into your bank. Besides for all the tax benefits and the other stuff that we spoke about in the last episode, that's straight cash flow. Year two, 7,350, 7,540, 7,900. Steady increases every year, right?
Why are there increases every year, and how do you know that there will be increases?
So as inflation, just year by year, right? They say a dollar today is worth more than a dollar tomorrow, right? Because you can invest that dollar and generate returns. So same thing. Just as first of all, generally prices of real estate go up over time, and that's because rents go up over time because inflation happens, wages go up, and every time a lease expires, you're going to go up to that tenant and say, we're renewing you for a 2% increase, right?
All right.
If it's a hot market, it could be a 4% increase, right? Every time if you live in an apartment or if you have lived in an apartment, you get that lease renewal, it's a 2% increase. So it goes from.
So we're assuming that in real estate there will be an increase in income due to increase in rents.
yeah, and rents and in the parking garages or whatever.
Okay, we are assuming that. Okay.
Yeah. Sorry. Yeah. So that's how the increases are happening, right?
Okay.
And that's why people say real estate's a great hedge against inflation because it could keep up and most of the time outpace the rate of inflation. So especially this year where inflation rates are through the roof, if you have a piece of real estate only earning you 3%, you're actually losing value.
Wow.
On your real estate. So, but if real estate's earning you a 10% return on your money, you're pretty safe, right? It's
Right.
a good hedge. So right. Let's assume steadily you're seeing a nice increase. Year 5, right before you sell the asset, you make 100. So here are your cash on cash returns. Cash on cash returns just means your return divided by your initial investment. So it's for example, year 3 is 75.40 divided by your $100,000 investment over here. That's how you get a 7.54 return.
Okay. Cool.
Make sense?
Yeah.
Fine. When you sell the property now, you now received at the sale, because you guys are my 2 investors, whatever amount we decide to sell for. I didn't run the calculations, exactly with the
all good.
Let's say you receive sales proceeds. You guys get a check at the end of the sale for $160,000.
Right.
That's a great return, right?
Is that $160,000 just based strictly on the sale price?
Yeah, sale price minus whatever outstanding mortgage payment we had, whatever was left over, based on your share of that property, prorated. For example, if it was me, you, and Zach going in it, even though you guys gave me the $100,000 each, and I put in no money, let's say, we're still going to say we're 33% partners. So let's say there was now $480,000 of profits to share. You received 160 of it.
Okay, got it.
Right.
Let's say. So now you just received your entire capital of $100,000 back plus 60,000 in the sale. Total profit is 97,990.
Mm-hmm.
Because you have all this minus your $100,000 investment.
Got it.
That equals 97,900. So you're gonna say, sounds great, right?
Sounds really good.
There's a but. What's the but?
The but is, if I had that $100,000 and I could have put it in another deal, how do I know which deal is better? So this we'll call stable. We'll call this stable asset, right?
Mm-hmm.
We call this nice, clean deal. But I say to you, Dov and Zack, I found a better deal. We can make a better deal. The profit may not be as high as a 97,000, but it'll be a better return on your money during the life of this asset, the 5 years. What do I mean by this? You have a value add deal. You have a property that looks like this. Not a really bad property, but you see maybe, the driveway needs some work. Maybe it's a little outdated. Just looks a little bit old.
You're going to have to redo the stucco. The roof needs a fixing, things like that.
Yeah.
Okay.
The old manager's an old guy, wants to get out of the property, hasn't really been taking care of it. So you say, great, I'll buy it. I'll fix it up, really revitalize the community and make it a great asset. So what do I say to you guys? Say, guys, we just sold this asset up here. I have a better deal for you. Put another $100,000 in. Again, let's assume we're buying it for $800,000. You'd probably be overpaying for it because if you can get this for $800,000, why are we buying this? But maybe it's a better deal. Let's see. You put $100,000 into this deal instead. Year 1, you're receiving $2,700 of cash flow. So that's an awful return. That's 2.7% on your money.
Right. That's lower than inflation in theory.
Yeah, lower than inflation. And also just remember, I can get much more just putting into some index fund, right? So why am I putting it here? Well, guess what? Year 2, how did the cash flow jump to $85,000? Something's off. No, it's because you received back a huge chunk of your initial $100,000 investment because by year 2, we've already gone in, we've renovated the units that needed work, we've raised the rents, right? Because if we make the units nicer, and you were at market rents of $500, but now because you renovated, you can get up to $800. You've now raised. Once you've done that over 30 units, the NOI on the property drove up $100,000, now making your property worth much more. So you go back to the bank and say, bank, I bought a property worth $800,000. I made it now worth $1.5 million. Give me a loan for 75% of that new value. So you have $1.5 million times 75% of that. The bank's going to give you a loan for $1.125 million. I can now pay off my existing loan that I got from the bank for the $600,000, right? Because we bought a property for $800,000 and we had a loan right? You could pay off that existing loan. Now you just cashed out that money that you made in the cash out refinance, that difference between the 1.125 million and the 600,000, that's equity. It's not income that you're get taxed on. That equity that you made is free money to be given back to the investors and given to you. Huge, powerful play, right?
Okay, so hold on. Let me try to do this into like, old guy numbers, okay?
Mhm.
All right. So I have my house, it's worth $100,000. I have a mortgage of $90,000, okay?
Mhm.
Right? I do a lot of work to my house or this building or whatever we're talking about. Oh, now it's worth $500,000. I go back to the bank. I say, oh, I don't want a mortgage of $900,000. I want a mortgage of $400,000, right? So they give me $400,000. Now that you're telling me that $400,000 is actually equity in my money or
That's
my value. What is that?
that you probably heard commercials on the radio. It's like, now's the perfect time to do a cash out refinance. We're rates are
Yes.
so low, right? A cash out refinance is money. If they say, oh, if you need money for a home repair, do a cash out refinance. What does that mean? A cash out refinance, you're taking cash out of the building. A building or a home is a very illiquid asset, right? There's no as that money's tied up in the property, you can't access that money unless you take out a loan against the house, do a cash out refinance. And if you do a cash out refinance, you can actually take out that equity that's built up in that home, right? As you pay down your mortgage, you're building up equity.
So that's essentially what you just described, correct? It's
correct. Just with an apartment building, right?
Within okay, cool.
And instead of that money sitting in the property, say to the bank, I want to take it out and go do another deal.
I got it. So that's working capital, basically.
Working capital velocity. It's speeding up the velocity of your money, and the bank has no issue giving you that money, because guess what? The bank's gonna give you a loan based on a new value of the building. So even if you bought the building for $800,000, if you do a great job at renovating it and you raise the rents and learn to manage it efficiently, if the building's now worth $1.5 million, the bank's like, the building's worth $1.5 million. I'll give you a loan for 75%. They don't care if they're cashing you out. The bank wants a steady asset that can make them money. If you're paying them 3.5%, 4% on your money, they're able to lend that out now to other people, and just it continues to cycle for them.
And if you could basically, it's pretty easy to prove that this asset is now worth money. It's not. It's a building. It's a building with tenants, and that has had a significant amount of work done to it, and all that.
Yeah, they do an inspection, do an appraisal, and they look at your bank statements, make sure the money's actually coming in. And again, you go to a mortgage broker, go to a local bank, and let them refinance you out. So over here, year 2, we did our whole value add execution, so to speak, right? We took care of what we wanted to do. Now, I just gave Dov and Zack, I gave you guys back 85% of your $100,000 investment. That's a huge chunk of change, right? Yeah. So look at how our returns go up to 85% that year. Now, year 3, cash flow is $6,800. It went back down. Why? Because we're not doing another cash out refinance this year. But
we did it, but we're still making more money though now.
You're making more money, and look at your return on look at your cash on cash return in year 3. How did it go from 2.7 to 45%? The reason being is because your $6,800 of cash flow is not being divided by your initial investment of $100,000. It's being divided by whatever is remaining. I gave you back $85,000 of your dollars.
So now really, it's just $15,000 investment. Wow.
Exactly. So that's epic. Are now actually, it's crazy. It's crazy. People don't realize how much money is in real estate. For this reason, they just don't see the full picture here. But you just made a return of $6,800 divided by $15,000. That's a 45% return on your money. Right. There are if you want to see something crazy, there are instances someone does a good enough value add deal. This $85,000, they go to the bank and it actually appraises for, let's say, $2 million. And let's say they can now pull out $110,000.
Right. So they already got a profit.
They return their money, and here I just have the Excel made up. It's not gonna show up over here, but over here your returns would actually become infinity because there's no money left in the deal. So any penny you make,
any money you break is cash in your pocket. First of all,
cash in your pocket. And wouldn't you guys be happy with owning an asset that you have no money left in the deal? It's like, imagine you owned
There's no downside.
There's really no downside, especially once you get your money back. Again, and also the fact that you're an LP or limited partner in these deals, your investments, your risk is only limited to what you put in. So if what you put in has come out, you're great. Again, this is not to glamorize real estate that it's all butterflies and rainbows and it's always going to work like this. There are times, let's say your investor planned to get you $85,000, but they only get you $60,000 back. Your returns, and now you still have $40,000 in the deal, right? Your returns are now only 17%, right? Your returns are now only 17% here. Like, it's not as glamorous as it might look, right? At other times.
And now your IRR is going down like crazy.
Correct. You saw that? You saw your IRR go down? That's because I'll get into that in a second, but over there, as you see, right, 6,800, 6,900 in year 5, 7,100. Let's say at the sale, right? You only make $60,000 at the sale. Why? This property over here is just not worth as much as this. So you're not going to receive as much at the sale. But let's look over here. Your profit over here is 68.5. Your profit up here is 97.9. Everyone, I guarantee, if they didn't understand IRR, they'd say, take this top deal. But let's say you break it down, your IRR is 14% here, and you're 17% on this deal. Now let's take a step back for a second. For those who don't understand IRR, IRR pretty much means it means internal rate of return. That still doesn't work for a lot of people. Let's break it down even simpler. It's how quickly, again, this is not the exact definition, you look it up, but it's how quickly are you getting your money back to now put it into other deals. That's how I like to look at it. So in this deal, you're getting steady cash flow. You're getting great returns up front, right, as seen over here, but it's taking the full 5 years to get your money back. And even though you can still sell the asset for a larger amount, your IRR is 14%, which is fine.
So it's like about the opportunity that you could do with your money.
Exactly. It's opportunity cost. It's Econ 101. It's like, if I put money here, I don't have money for that deal. So I say to you, great, Zach and Dov, I have a deal down here that'll get your money back in year 2. If you had now $85,000 in 2 years back, you can go now put that money into another deal. And you still, and again, when I pay you back this money, you're not out of the deal. That'd be rude of me if I said, hey guys, let me use your money, and then once I pay you guys back, you're off. No, you're gonna be my partner. You're gonna be my partners throughout the deal until we sell.
It's pretty cool how, like, the way real estate works. It's not like the deal that you're in now. It's always like the deal that you're in now, but looking for the next deal. That's how it seems to be. It's, well, yes, you can in theory have building number 1 on top and just have the steady income, but the building number 2 on the bottom really does seem like both the way to go in terms of the long game, and a very very interesting way to do the math. I never would have thought that's the way that the math would work on something like this.
Correct.
That's fascinating.
And one note to share is, although the second deal, that was a very high level, right? I gave very simple terms and very simple numbers. There's a lot more that goes into the deal. So Dov, you might say, Rafi, I really just want to, I'm fine not getting my money back in 5 years. I really just want a steadier deal. I don't want one of these value adds.
Right.
Maybe you haven't done a value add before. Maybe you only done steady deals. I don't want the risk. Fine. That first deal might be a better deal for you. Zach might say, I'm chilling. I want to drop money in. I want to hit a home run here. He might choose for that home run deal that might have more risk. It's like one of those, the stocks where that company's trying out a new drug and it could skyrocket. It could also go drop.
Right.
Same exact thing, just in terms of real estate. You have a value add deal. Again, if it's an operator who's done many deals like the value add strategy, then and they've shown you time and time again that they do it well, you'll probably hit hit a double or triple. And shouldn't expect a home run, but if you hit a double or triple, it's great.
That's pretty good.
Right, and like it wasn't like the IRR in that example was like a crazy amount more. It was just like a nice amount more.
Right. Yeah, exactly. And when I was playing around the numbers, I saw some absurd numbers I was playing with. I was like, all right, let's try to make it a little bit more realistic here. But there are times, especially in this market right now, where home prices are crazy, apartment building prices are crazy. There are people who bought buildings right before COVID for, let's say, $20 million. They've done very few renovations, and just because of the market, the natural market appreciation, they've sold the building 2 years later for double the price, and their IRRs went from like projected 21% IRR to like literally like a 65% IRR. It's absurd.
That's crazy.
So, and again, that there wasn't a lot what they did, but it's partially what they did in the market. So the market plays into it also. So if you were planning on selling in year 5, and year 5 was the year COVID happened, well, maybe you choose to tell your investors, let's hold on for a couple of years.
Wow.
Right? It might hurt your IRR, but they'll still make steady returns. So it's all just about knowing your operator, knowing the investors doing the deal, and making sure that as a limited partner, right? If I'm bringing you a deal, that you make sure these numbers make sense. Can you actually raise the rents 2% a year? Right? Can you actually decrease the expenses by this much that you're saying? It's a lot to look into.
Wow. Amazing.
Thanks so much.
Rafi, the real estate guy, absolutely knocking it out of the park. By the way, to me, this almost sounds like the Yankees, the way they play would be one kind of deal, and the Tampa Bay Rays, the way they play.
Yes.
Like the small ball versus trying to hit the home run every time.
Right.
Where you might strike out a bunch, but wow. Unbelievable educational stuff. Rafi, the real estate guy, Zachary Moneybag Greenberg, Digital Dove coming at you live from Making Sense. We hope you enjoyed this very informative. I really like this show. This was really cool. Very informative show on different kinds of real estate. And we'll get you at the next one. See ya.
Thanks for having me.
Bye.